Ladies and gentlemen, good day and welcome to Chalet Hotels Limited Q2FY22 Earnings Conference call. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjay Sethi, Managing Director and CEO of Chalet Hotels. Thank you. And over to you, sir.
Thank you. Good morning, ladies and gentlemen. After 6 quarters of various levels of lockdown, the hospitality industry has seen business momentum pick up, led by a positive consumer sentiment and easing of restrictions. And I guess the industry is quite excited about it. Globally, over 38% of the population has now been fully vaccinated, and key markets such as UK, US, Singapore, and UAE have between 60 and 80% of the population fully vaccinated. In India, as you know, we recently hit the 1 billion dose mark, and over 32% of the eligible population is now fully vaccinated. At Chalet, 99% of the team has got the first jab, and 80% have received both jabs. The gap's only because there are a certain number of weeks before the second jab, and another 2 or 3 weeks we would actually have got almost everyone double jabbed. Major business cities have seen restrictions being eased, and domestic corporates have restarted work from office. Business travel is also on the rise. The air traffic passenger numbers in India were around 55% of pre-COVID levels in September, with domestic airlines now permitted full capacity. India has seen some of the highest ever single-day air traffic numbers during the COVID period for the current month, which is October. Before I start with the overview of our business performance for the quarter gone by, let me update you on a key development on one of our dormant projects. As you know, we have a residential project at Koramangala in Bengaluru, which was stuck in litigation over cancellations of an earlier issued NOC for height by HAL. The project was under development with several towers at various stages of completion. We have worked out a revised development plan and have executed settlement terms with HAL. I'm happy to share the Honorable High Court of Karnataka has passed the final orders, and this marks the closure of the long-standing litigation on the project. We will recommence development shortly to unlock value for the asset. In addition, all 83 of the continuing flat owners are aligned with the new plans and will soon be submitting applications for requisite approvals for commencing the project. And I'd like to highlight here that this project is branded as a Vivarea product, which is a luxury brand. And for those of you who are familiar with the Mumbai Vivarea will know that it stands right at the top amongst the residential buildings in Mumbai. In addition to that, the location of Koramangala being the most premium in Bangalore for residential, we do expect significant amount of value addition through activation of this project or reactivation of this project. The revised plans include 11 residential towers and a commercial building for starter sale. Milind will take you through some of the key numbers on the project shortly. For the quarter ended September 2021, at the consolidated level, we've clocked an adjusted revenue of 1.16 billion rupees against 696 million in Q1 of the year, which is a growth of 67%. Adjusted EBITDA was at 253 million against 24 million in Q1 and 11x growth. As hospitality segment progresses on stabilizing operations, we are witnessing quick ramp up in performances. For the division, we reported 911 million of revenue against 462 million in Q1, higher by 99%. And an EBITDA of 138 million against a loss of 99 million in Q1. Occupancies at our hotels have climbed to 56% for the quarter ending September, up by 20% points, and RevPAR was at 2161, up from 1252 in Q1. October continues to follow the trend, and the occupancy till date for the portfolio is 59%, with an average room rate of 4,330 odd, which is up 11% as compared to Q2. In mid-August, hours of operation of F&B in Maharashtra were increased till 10 p.m. from an earlier restriction to 8 p.m. instead of 4 p.m. Apologies for that. The same has subsequently been revised to midnight from last week. This bodes well for the business given the commencement of the festive season. F&B revenues have seen a sharp uptick and were sequentially up by 167% for the last quarter. Rooms and F&B respectively contribute 55% and 38% of the hospitality revenue for the company. We have been evaluating the performance of our non-hotel assets for best suited use. The In-Orbit Mall at Bangalore has been underperforming for a while. The onset of the pandemic kept malls shut across the country for several months and impacted retailers. As a quick pivot to optimize the asset, we have started work on repurposing the space and will be converting the same to a commercial office product, adding another 0.3 million of square foot of commercial assets to our portfolio of 0.6 million square foot in Bengaluru. So this will additionally add about 0.9 million of new office space at the Whitefield location. Work on conversion of retail space at Sahar has progressed well. We are in the process of leasing the current space currently. In fact, leave and license agreements for 25% of the space have already been executed, and the tenants have started fit-out works. One of the tenants actually expects to begin office on that location from late November. On the growth pipeline, the two commercial development projects with an area of 1.4 million square foot are progressing well and in line with the timelines shared on previous calls. The commercial tower at Bengaluru now has a revised area of 0.66 million as against 0.45 million earlier, because we've been able to add 2 more floors to the structure. Basically, the cinema theater that is coming, multiplex that is coming in that tower to support the mall, with the mall going out of action, has now been converted to 2 additional office floors. The estimated cost of the Powai project, however, has gone up on account of steep increase in commodity prices, especially steel. We continue to evaluate demand dynamics to assess the opening of the new hotel in Hyderabad, expansion of capacity in Pune, and the rebranding of the Powai hotel. We are also evaluating demand metrics for Airoli to take a decision on the way forward for the 260-room Hyatt Regency in the Mindspace complex over there. The renovation work at Renaissance Mumbai is at its last leg. With this, we are targeting the rebranding to Westin in Q4 of this year. The last year and a half have been challenging and unpredictable. We have streamlined our business over the past few quarters, remobilized dormant assets, and repurposed underperforming ones. In addition, Chalet has significant value yet to be unlocked from its existing balance sheet, and I look forward to discussing the same in the near future with you. I now hand over to Milind, our CFO, to take you through some of the finer details on the financial performance.
Thank you, Sanjay. Good morning, ladies and gentlemen. Reported revenue for the quarter was 1,376 million, which includes 161 million received from a commercial tenant on account of early termination of contract, rupees 50 million ACIS income, which was written off in FY21, and a rebate received from an operator of 4.6 million for past disputed liability. Adjusting for the same, the revenue was at 1161 million, 116 crores, against adjusted revenue of 696 million in Q1 of this year, a growth of 67%. Further, we accounted rupees 33.6 million for interest on cancellation of 3 flats at our residential project in Koramangala. Adjusting for this, EBITDA was at 253 million against adjusted EBITDA of 24 million in Q1 of this year. PBT post charges on depreciation and interest for the company was negative of 278 million as against negative of 693 million in the sequential quarter of Q1. After taking credit for deferred tax asset of rupees 140 million, loss after tax was at 138 million. The hospitality segment contributed to 79% of the total income of the company. On the cost front, we continue to maintain lower fixed and variable cost compared to our pre-COVID performance. Fixed cost was lower by approximately 37% and variable costs were lower by 44% as compared to pre-COVID Q2 financial year 20. The variable costs are expected to rationalize as operations scale up, whereas our strategic initiatives on cost will keep the variable cost contribution lower than traditional levels. Revenue and EBITDA from retail and commercial segment was at 377 million and 326 million for the quarter respectively. Adjusting for compensation received from the tenant, the revenue was at 206 million and EBITDA was at 172 million. As mentioned by Sanjay, we are repurposing In-Orbit Mall at Bangalore. The contribution from our malls were not significant during the quarter under review. With conversion of retail spaces to commercial office spaces, the conversion of retail and spaces into office spaces will be EBITDA and return accretive and stabilize earnings from retail assets further. Debt for the company in the first 6 months has gone up by 171 crore, which included 135 crore capex spend. The net debt of the company as at September 21 stands at 2,042 crores. Our cash PBT, that is EBITDA less finance cost for Q2 FY21 has been 48 million, which has turned positive for the first time since the pandemic hit us. This was led by prudent cash flow, working capital management, along with other strategic initiatives. The average cost of rupee loan as at September 21 stands at 7.57, an improvement of 47 bips since March 21. We have cash and cash equivalent of around 57 crores as at September 21 and 710 crore rupees available lines of credit for general corporate purpose and planned capex. We have received a new subscription of 500 million from promoters on the 0% non-convertible redeemable preference shares for funding the outflows relating to residential project at Koramangala. The total subscription now stands at 175 crores. As briefed by Sanjay, the project has seen a closure on litigation. With the new development plans, we'll have 9 towers of 10 floors and 2 towers of 11 floors each, totaling to 8.5 lakh square feet of residential area. There will be additional 1.5 lakh square feet of commercial space for strata sale. Out of these, 2.8 lakh square feet of residential project is already sold and the balance sellable area is around 5.7 lakh square feet. The cost estimated to complete this project, including commercial space, commercial building, will be in the range of 425 crore. And the project is expected to be completed by FY26. With this, we now open the floor to questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask any question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may please press star and 2. Participants are requested to use handset while asking a question. To ask a question, you may please press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Karan Khanna from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Firstly, on your residential portfolio at Koramangala, including the commercial part, you mentioned about 425 crores of CapEx to finish the project. Can you give us some sense on the expected cash flows that you would be estimating internally, along with the split between sold and unsold part, including the commercial strata sale?
Certainly, I'll let Milind address that. But, Karan, as an overview, from here onwards, we largely expect the outflow to be supported by sales. We still have, as Milind mentioned, some money left over to be drawn up from the preference shares from the promoters. That should be more than adequate to take us to the next level. But Milind will come in details.
So, Karan, we have around 5.68 lakh square feet residential area for sale and around 1.5 lakh square feet commercial area. Cost, we already mentioned, it's going to be in the range of 425 crore rupees. And on revenue side, we don't want to give forward-looking numbers, but the expected selling price per square feet is expected to be much higher than our previous estimates.
Sure. But any ballpark number that you can share?
So, Karan, it's like this. I mean, we expect the base price to be comfortably northwards of 13,000 a square foot. Add to that floor rise, parking, etc. And this is the base starting price. As the project progresses, the price will increase. We are very confident that we see numbers northwards of 15,000 rupees.
No. Secondly, on your commercial portfolio, can you give us some sense on your exit negotiations with the tenants for the in-orbit mall? And as a follow-up, you would now have a little more than 1 million square feet of commercial real estate in the Whitefield market over the next 3 quarters. What we understand is that the Whitefield market already has vacant office space with significant supply hitting the market over the next 4 to 6 quarters. In that context, can you help us with your thoughts on the same along with leasing timeline for all the 3 blocks separately? That's the 1 million square feet of recently vacated area, 0.3 million square feet of in-orbit conversion, and 0.66 million square feet of the new construction, along with expected rentals, if you can share.
So, Karan, we've got more than enough or adequate queries, and the list on our sales tracker is long. We obviously couldn't lease out the mall area till we had our tenants vacated, and the Accenture Learning Centers just recently got vacated, so we couldn't mobilize those 2. But on the new office tower, which is expected to be commissioned in Q4 of this year, end of Q4 of this year, there is significant interest. We've also got potential tenants now doing site visits for the current in-orbit mall, which is, as we speak, being dismantled to reconfigure it to an office space. The Accenture Learning Center is the way it is. We still have retained the 67 rooms that were there, and we've added that to the hotel inventory in Whitefield, Bangalore. We don't have any concrete numbers to share with you before we actually close the deals themselves. So that will be a little premature. However, keep in mind that whilst there may be vacant space within Whitefield, the quality of assets makes a lot of difference. The provision of the hotel connected to this office space and the metro station, literally you get off the metro station and you're on the property, is both a clear advantage for this particular complex, and we expect to get serious traction on it.
Sure. And lastly, on your hospitality portfolio, you've mentioned in your investor presentation that currently, I think occupancy is around 59%. Is it possible to get some sense on, the city-wise occupancy and ARR trends in the month of October? That would be my last question.
So, city-wise October numbers will be, I can give you a flavor of it. The Marriott Executive Apartment, I'm starting off with Hawaii, is at 75% occupancy in October. But this is, we have not really shared this publicly, so we might need to keep it overview of 59%. Let me give you an overview that the ones that are of concern, only one hotel is of concern. That's the Whitefield Bengaluru Marriott.
That's right. Okay.
Which has lower occupancies than the rest of the portfolio and has dragged the average down. But you must remember that 67 rooms just got vacated over there, which were giving us 100% occupancy for the period. So you might see a sharp drop there, but that's going to be filled up very soon. And the recent weeks, we've seen business travel come back there, and the occupancies are climbing up. So when we report occupancy of Whitefield Marriott, we are reporting on the full inventory of 324 plus 67 rooms, that's 391 rooms, and therefore the occupancy may look a little muted. But on the original occupancy, it goes up 6.5% on the original inventory of 324 rooms. So that's the only hotel that we're concerned with, because Whitefield has taken slightly longer than the rest of the country to pick up on account of the nature of business in that area. But as international travel and the IT companies start traveling, even domestic companies, we see that picking up. We are not really so concerned about that hotel, and it's a brilliant hotel. It's always been the best performing hotel in that market. Not just in Whitefield, it has performed amongst the best in the whole city. And we do know that when things come back, they will come back with a bang for that hotel. I mean, our outperformers are clearly the JW Marriott Sahar, the Pune Novotel, the 4 Point Sheraton, and the Marriott Executive Apartment.
Sure. All right. Okay, great. Thanks a lot and all the best. Thank you.
Thank you very much. A reminder to the participant to ask a question. You may please press star and 1. The next question is from the line of Vikas Ahuja from Antique Stock Broking. Please go ahead.
Yeah, thank you. Good morning, Sanjay. Good morning, Milind. Thank you for the opportunity and congrats on decent results and strong execution. My first question is, our exposure is largely corporate, so we are currently at a little disadvantage to peers with strong leisure presence. But do we think with the trend of mostly all corporates now are looking to call back people back to office, even the tech companies which were claiming work from home and Zoom meetings is a new normal, almost planning to call more than 90% of their staff back next year. So any early indication we are getting, if there is no third wave, do we think maybe in FY23 we will see a very strong pickup in leisure, especially on the pricing side?
Thank you, Vikas, for the question. I hope you're doing well. Yes, we do expect that things will come back and ramp up on business travel pretty soon. And with that return of business travel and add to that the new revenue streams that we've developed over the last 18 months, we do expect FY23 to look a lot stronger. Our previous estimate was that we should be back to or close to normal numbers from October of next year. I think we retain that outlook, and FY24 as a whole year is likely to be a good year, and we should be back to pre-COVID numbers. I must also add here that we've been looking at some lead indicators of what's happening in the market. 2 lead indicators that we're looking at. One is the growth in air passenger travel. And we see now a significant percentage of the flights in key sectors of Delhi, Mumbai, Hyderabad, Bangalore, Chennai, and Pune is closed for a bit, but it'll open day after tomorrow, are now business travelers. A clear indication that the people have started traveling for work. So that's one strong indication. The second indicator that we looked at is the hiring patterns of companies, and the hiring patterns have been very, very strong. Just to give you an indication, one metric that we look at is what is the leasing trend for these increased hires within these companies. And I was speaking to our leasing head within the group companies, and he said for every 5 people that they are hiring, they are adding on 4 extra seats within the office spaces. And this hasn't changed. This was the number that we had even pre-COVID. So potential tenants potential businesses who are our key accounts for our hotels all seem to be hiring well, and they seem to be providing 4 office spaces for every 5 hires that they do. All good positive indicators. In addition to that, the special corporate, which is your contracted corporate travel accounts in our segmentation, we see that 28 to 30% month-on-month increase between September and October, 28 to 30% actually on month-on-month increase between September and October on that segment, which again is a good strong trend. And in addition to that, we've got staycations which are improving also with 5% with higher ADRs. What we've been able to do with occupancy is improving. For the rest of the retail segment, which is our visible rates, as we call them bar rates, best available rates, have gone up. So if today you were to scan for some of our hotels which have high occupancies, the visible rate in those markets are now almost about 60% higher than they were about a month and a half back. And finally, the RFP cycle for the next year has started, and we were at a meeting with Marriott and Accor yesterday, and they confirmed that there is no discounting happening on the global corporate accounts as far as the room rates are concerned, and most of the accounts are likely to be closed at 2019 rates.
Okay, this is very helpful, sir. And also for hotels, do we have any plans of? I know currently we have no plans of moving to leisure and all, but from medium to long-term perspective, do you think that we can actually also move into leisure, or do you think the parent being a commercial builder, so synergies are better only with city hotels?
No, I don't think the second part is true. Chalet will look at its own portfolio and reassess its strategies according to what the requirement of the day are. The leisure has been a growth area as a strategy for the last 3-4 years now for us. We've stated that in almost every call that we've had, that we do want to get into the leisure space. We haven't found suitable assets that work for us. We don't want to take development risk in work for now. We'd rather acquire an asset if it's available. So that's one. Second, and you must look at it, it's a very interesting phenomenon that's happened over the last 18 months. Whilst we say that we are not in the leisure destinations, we've created leisure products within the cities. A large part of the business is actually coming out of people who are taking staycations, which is basically the purpose of the staycation is leisure. So what we've done is we've created what are known as urban resorts within the cities, within the existing hotel profile, and created a new segment for them. Powai is a clear example of the location and taking the locational advantage of the lakefront to grow their staycation. We had strong staycations even in Pune and 4 Points by Sheraton in Vashi. JW Sahara has had strong staycations. And I think as I mentioned in my opening statement, the conversion of the Renaissance into Westin sometime maybe January of the next year will reposition it as a product also, because Westin is all about wellness as a brand. So we see a significant move on the guest profile over there. I hope that addresses your question.
Yes, that's it. I also have a follow-up for Milind. Milind, so last quarter, you talked about our capex and the debt target. So capex, you said it would be around 850 crore in next 2.5 years, and debt would be peaking at 250, around 2,500 crore. So any changes with that? Because I know there has been some delays and any changes to these numbers. And also I have a follow-up, one clarification of the preference loan by promoter. So just correct me if I'm wrong. The total debt we report, that does not include the promoter's preference loan. And once you start getting cash flows from the real estate project, so how that money will go back to promoter? Is it like it's going to be in the initial phase, or that is the last thing? These two ones. Thanks.
Okay. Vikas, let me take your questions one by one. On capex 850 crore rupees, we have spent around 100 crore, 135 crore rupees in the last quarter. So to that extent, it will come down. Our peak debt estimate remains at same 2550. May go up little on account of this increase in cost of project, but that not really significant. On these preference shares, it will be redeemed out of surplus cash generated from this project. So it's not initial outflow. Whenever we have surplus, after meeting all project-related expenses, it will be redeemed. Hope I have answered all your questions.
Yes, sir, you did. Thanks a lot and best of luck.
Thank you.
Thank you very much. The next question is from the line of Prateek Poddar from Nippon India. Please go ahead.
Yeah, hi. So when I look at others' expenses as a line item, is there any one-off or this is a sustainable run rate? I would have thought that the incremental flow-through of revenue into EBITDA, that should have been better given our cost cuts. So just wanted to understand that. Is there any one-off over here or these are the normal expenses?
No, these are normal expenses, except
I think one expense that will be one-off is your payment to the exits that we had at Koramangala, 3 people. And we also wrote back the SLM revenue that we had from Accenture, which could be an overall impact. But you've got to keep in mind that now the salaries are getting normalized, and as business and occupancies improve, we are hiring. As if you recall from our earlier conversations, we had come down to 0.72 employees at the last quarter. We are now up to 0.78 or 79. I can't remember the exact number. So there has been hiring to take care of the extra guests that we have in the hotels. So those are costs that are going to continue to go up. One of the commitments that we have is that we have capped our manning numbers at a portfolio level to 0.9 employees to a room when we have full business back. So I think we'll still be far more efficient than we were pre-pandemic on those numbers. Besides that, there is no really exceptional expenses over here, or maybe unless Nitin wants to add something.
So our revenue, hospitality revenue, has gone up from 67 to 128 crores. So it's more than double. And more or less on the same lines, our other expenses have gone up.
So the way I was looking at it was sequentially, if I see your revenue growth in the hospitality segment, and when I see the EBITDA delta, the flow through is around 55%. I would have thought this would have been slightly higher given the amount, the way fixed costs have been contained. So that was just a limited point which I was trying to understand.
I want to highlight one thing, and I did touch upon it earlier, that the exit of Accenture, which was revenue that was coming to us without any cost, and the flow through was almost 100% there, is not there starting after first week of September, or after first week of August rather, and therefore there could be some difference, a marginal gap on account of it. However, if you really look at our EBITDA line has climbed up fairly sharply in the hospitality performance from a negative EBITDA of 99 million to a positive EBITDA of 13.8. So the gap is 237 million rupees against a revenue increase of 400 odd million.
Got it. No, this is really helpful, sir. So second question was, I think, just elaborating or building upon Karan's question. By when do you expect Accenture has left, right? And then you also have the 2 properties of the Inorbit Mall as well as the new commercial property which is coming up.
Yeah.
In your best estimate, is 1 year something which you would look for to fill up these properties, or this could take some while? I'm just trying to understand the time period required to fill these properties, not asking for any number.
Sure.
Just broad sense as to by when can we fill up these properties.
Sure. So look, Pradeep, I think Milind will give you a little more flavor on this, but let me give you an overview. The Accenture exit has been actually advantageous to us because their lease was signed up about 5 years back at low rental. and they had a lock-in period, so they actually paid us right up to 2024 for the rooms. So we've got literally 3 years of revenue in advance. Similarly, they had a lock-in period, or rather notice period on the office assets and a couple of other operating services that we were providing. They have honored that and given us the funds upfront. We expect to end up somewhere between 1.5 to 2 years accretive, in the sense that we've got the rent till 24. We'll probably lease it out 1.5 to 2 years before that ends. So we'll actually get double dipping on that asset as far as rent is concerned for at least 1.5 years.
So Pratik, to answer your questions, the completion timelines for these buildings are different. I mean, our commercial block will get ready maybe by end of next quarter, and it will be offered to tenants for fit outs. Whereas this conversion of mall may take 9 months for construction period post approval. So maybe 1 year from today. Okay. So by the time our mall is ready, major portion of our new office building will be leased out. And there are serious inquiries leads for existing Accenture Learning Center. But to answer your question further, I mean, the entire leasing may not happen in one financial year. It may spread over maybe 2 financial years.
I see an 18-month for 100% leasing period from now. In fact, I'd just like to update you that we've received the MOE of approval for conversion of the mall. So that's one big time-consuming approval has already come in. So that time lag that Milind was speaking about could shorten further. And as we speak, the dismantling of the mall is already happening with the MOE of approval. So what Milind is trying to say is, in the next 18 months, we're likely to have complete leasing of this 0.9 million square feet.
Great. Just last question. When I see, and it's no rocket science, but when I see today ADRs, the visible ADRs on various OTAs, we seem above pre-COVID in MMR. Is that a fair understanding?
Not the ADRs, but the best available rates may be high, but they fluctuate depending on occupancies, day of the week, and demand in that particular location or city. That keeps going up and down because that's changed on a daily basis by the revenue managers who have. We are at Sahar is now at about 10,000 odd rupees on the best available rate on the public rates. That's also driven by the fact that Sahar has a very large block of 400 rooms occupied for a period of 3 months. By 3 months, right? Yeah, 3 months. By Disney Hotstar, which is first covered the IPL and then subsequently the World Cup that's happening, the T20 World Cup. And they'll continue to occupy that till mid-November. So that left us only 188 rooms. And what we've done is we've optimized those 188 rooms to make sure that we get higher rates for them. September and October, we have seen occupancies at JW Sahar at 90%. So that hotel is clearly outperforming the market, and the market share of that hotel is very, very strong. So the rates will fluctuate depending on demand. Bangalore will be the lowest if you go to the website for OTAs, followed by maybe Hyderabad. Renaissance continues to be strong. 4 Points is actually now giving rates which are back to almost close to 2019 rates because the occupancies are in the mid to high 70s there. Last few days we've clocked close to 85-90% occupancies in that hotel. And a large part of that business that's coming in there is now business travel.
Got it. And just so from an industry perspective, do you expect this momentum to further accelerate in Q4 of this year? Because business will further open up, there'll be more travels, as you indicated also about the lead indicators. This will just build on, right? So from here on also, we should think about industry in Q4 being much better than Q3, especially on the corporate side, right?
So, Pratik, we see month-on-month improvement in corporate travel. As I mentioned earlier, we've seen 28 to 30% increase month on month between September and October on corporate travel itself. And that's a rapid pace of improvement. And, October still has its own challenges of the Dussehra and all of that in between. In spite of that, we see it grow up. We may see a slight drop in the Diwali week, which is the next week. But after that, the ramp up again is going to be extremely sharp. In fact, our view is that the early pickup that had happened about 3-4 months back on domestic corporate travel was going up very sharply. But we see the next big step up happening post Diwali, and the second big step up happening post the first week of January, when the post Christmas Diwali and New Year's traffic comes back. I must highlight over here that the wedding season looks very, very bullish. For our hotels of Powai and Renaissance, we are seeing a very solid improvement on bookings and confirmations for weddings in the hotel. There still are restrictions in Mumbai, but we're working with those restrictions, and we'll be able to deliver good numbers on the weddings. For example, now the restrictions in Mumbai have now been changed from 50 people to now 50% of the hall capacity, and because we have large halls connected with large lawns and multiple halls together, our ability to take large weddings is very high. The Novotel, for example, did a massive promotion on Viva, which is a wedding promotion for the Accor group, and they've recently got 70 lakhs of wedding revenues. Shadi by Marriott again, which was an initiative that they started, I think about 2 or 3 years back, has kicked off very well. They have a dedicated website for that, and that's generating huge amount of leads. They did share numbers with us, but I don't want to share them right now. But the numbers of leads that they're getting are phenomenal, both Accor and Marriott. We're extremely excited about the wedding business. And now with that starting in the next week or so, we see this going right up to early April. We should see a strong production out of that segment.
If I may ask, sir, is Renaissance also back to 2019 levels in terms of ADRs? We talked about 4 point.
No, Renaissance is not. Renaissance has a very large inventory of 771 rooms between the hotel and the Marriott Executive Apartment. So right now we are focusing on the occupancy part of it, not worrying too much about the rates right now. But as a market overall, we've seen the rates go up within the micro market around the airport, and that will lift Renaissance rates also. And the next big step of our Renaissance is actually going to be the rebranding in January when it moves to Westin.
Got it. And last question, sir, just from an industry perspective, are you seeing a material difference between, let's say, a 1-star or a 2-star hotel versus 5-star hotels in terms of pricing and occupancy? As in, people are not preferring to go to 1 and 2 stars, but because of whatever the scare, people are more willing to pay a slightly higher premium and go towards 5-star. Hence, you are occupying a better occupancy, or let's say the 5-star hotels are getting a better ORR versus what a 2 and 3-star would be getting, or that's not the case, it's the same across the board?
So I've really not seen the 1 and 2-star numbers, Prateek, but I won't be able to comment. My view, general view is that there is a market for every price point, and there's a demand for every price point. So whilst that profile of the guest may change category to category, but even as you go down the value, there will be a demand for 1,000 rupee rooms also, always. So that's always there. Yes, as far as corporate travel is concerned, given the risk associated with on the health front, the corporates are more comfortable going with the top end of the hotels, because they don't want to put their employees at risk, because that then puts them at risk from their employees if anything goes wrong. So the trust in brands is where they're placing the majority of their guests. The global standards that are followed at our hotels of our category are clearly the preferred hotels for a lot of the corporate houses and their administrative teams to book at.
I'll come back with the question, please.
Sorry, Prateek, to answer your question on other expenses, royalty and management fees which we pay to our operators has gone up in line with the increase in business. commission which we pay to OTAs and other companies has gone up. So these are two major heads. Repairs and maintenance cost has gone up a little. These are 2-3 heads for increase in, and these are purely operational expenses.
Can I just squeeze one last question on Koramangala? Given the way realty sector is behaving and the location and the premiumness of that location, from a pre-sale perspective, and given that that's a Bavaria brand, do you expect that the pre-sales would be very, very strong and maybe the project gets sold out in a very short span of time? I don't want any numbers, but directionally, FY26 is the date of completion, but would the pre-sales be so strong that you would have sold the project much before that?
So I think the two elements that will come into play on Koramangala. One is that the buildings, 9 out of the 11 buildings are substantially built. So, and the demand for residential is the highest that we've seen in many years across the country. Koramangala, Bangalore is amongst those districts that have seen high demand on the residential side. So yes, we see pace of bookings once we open up to be high. The second element is because the building is substantially completed, the payment, which is typically linked to construction, will be, literally at the 80-85% of the total value coming in upfront. It's only the 2 new towers where it will be linked to construction activity, where it may come in its own structure. But we do expect, once we open sales, that the bookings will yield higher upfront payments.
I think further to add to what Sanjay said, I mean, originally we had sold around 202 apartments. We have seen cancellation of 119 in last so many years. With a resolution to this litigation, I mean, few of our customers who have cancelled the flats and taken exited, so they may come back.
Okay. Got it. And so just yeah, I'll come back.
Thank you very much. Please come back in the queue. Thank you very much. The next question is from the line of Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. So firstly, on the capex part, can you give us breakup of pending capex between the hospitality and the commercial segment, along with timelines, especially for the Powai and Airoli Hotel, if possible?
So I'll give you the timelines for the million will come into the numbers on the capex. On Airoli, as we said, we are evaluating the demand dynamics. From the time we decide to start, we see roughly a 30-month time to open the hotel. There was one issue that was stuck in Mumbai and was holding back a lot of the large projects, was the Flamingo issue in the area that is a protected area around it of 10 kilometers. That's been reduced to 4 kilometers, so all our projects are now clear from that restriction. And we had already taken approvals for the hotel as it was for most of the approvals about 2 years back. We need to revalidate some of those approvals. So I don't think approval is going to be a challenge. The only thing in play there is where are we on the demand. So we need to right time the asset, and we'll right time it with the demand pickup. My general input right now is, and it's my gut feel, that I think we are good to go in the near future.
So Amandeep, our total capex plan for next 1.5 year is around 770 crores. Out of that, 200 crore rupees is for hotels and balance is for commercial office buildings. Again, this 200, out of this 200 for hotel, 150 will spend in next financial year. That is for completion of Hyderabad hotel, addition of 88 rooms in Pune, and part of Renaissance rebranding to Westin.
Sure, sir. Thank you. And what would be the expected capex for including the Airoli and the Powai project, upcoming hotel?
So Powai upcoming hotel is now a question mark. We have to take a call on this. We haven't taken a call. Now, there are two options here. Now, if Powai given that we have 771 rooms today, do we want to add another 150 rooms in the environment that we've just seen? Is something we need to reevaluate. And if we were to reevaluate and decide not to go ahead with that project, that opens up a massive land parcel to us for alternate asset classes to be put there. So that's something that we got to study, evaluate, and we will come back to you at the right time.
Sure, sir. And so secondly, as a follow-up to the previous participant, so you mentioned that 9 towers are already constructed. So, but you have given a timeline of say more 4 years to construct the remaining 2 towers. So, is this a conservative guidance, or you think it will take 4 years to construct the remaining 2 towers along with the commercial part of it?
I mean, 4 years for completing entire sales. I mean, the construction time is around 2 years once we get all approvals.
Sure.
There's not too much of
we are very
approvals.
We are a bit conservative on sales velocity. So from that perspective, we are taking it at up to FY23.
Look, we don't want to come back to you with a sorry face at one point of time. We are giving it numbers that are conservative so we can outperform these numbers, both on rate per square foot and on timelines. By nature, the company and the group does not give out aggressive numbers. So this is what we're doing. As Milind said, 2 years is the 2.5 years is the construction time, but closing all sales, that's 100% of the apartments sold out, because that's when you record full revenue, is a 4-year period. This includes from now to May, which is the time required to dismantle the work that was done above 10 floors and to get the final approvals. So the sales will only start from June next year, and you must take note of that, please.
So this is really helpful, and yeah, my follow-up question was in respect to that only, that on the accounting aspect, this would be in line with India's 115. That means it would hit the P&L only after the project completion, right?
That's right, Amandeep. I mean, we'll follow India's 115 and we'll account it on completion of project.
So if you were to ask the same question to our project team, their answer would have been 2.5 years. Because you asked it to our CFO, he gave the answer as 2024, because 2026 rather, because he was looking at from recording in his accounts.
Sure, sir. Thanks, sir. That's all from my side. Thank you and all the best.
Thank you.
Thank you very much. The next question is from the line of Amit Agarwal from Nirmal Bang. Please go ahead.
Thanks a lot for the opportunity, sir. I have 2 questions. One is on this cash flow. You talked about the cash flow PBT of about 4.8, if I'm not mistaken. Is it including the one-offs, like a 16 crore you've got, and I think 5 crore for SIES and another 4 million or 4 crore from Marriott, or it strips it's stripping out these one-offs? Can you talk on that? And my second question is more on strategy. You're getting out of retail. So is that a strategic move to focus completely on hotel and office sector going ahead and no more retail? Or moving ahead, will there be any other vertical, or you'll just stick to office and hotel sector?
So I'll answer the strategic part first over here. The strategy is clearly to, some hotel companies would spread their risk by getting into business hotels, long stay products, leisure destinations, or holiday homes and that sort of stuff. We have done asset classes as our strategy for hedging the risk. And I think that's worked out well during the pandemic for us. You're right. We are with this exit in Orbit in Bangalore and the Orb in Mumbai, we will exit retail almost completely. The hotel assets or the office assets will have small format retail, of course. That's the normal offering of those products. So we will largely end up with hospitality and office assets as the asset classes that we'll be operating in. There's one residential project, but that's one that we'll conclude, and since it's an exit through sale, that will not remain with us for too long. However, hospitality will continue to contribute the largest part of the revenue. Now, Milind can come in with
Amit, to answer your question on PBT, cash PBT of 48 million, it is including one-off income. But this one-off income is supported with the hard cash, which we have received.
Sure. So operationally, these are one-off. So operationally, this time you probably would have been negative if if they were removed. Am I correct on that?
No, but operationally, our EBITDA is, netting of this adjustment has gone up from 2.4 million to 25 million for the quarter. Sequentially.
But you're right to a certain extent that we would still have been negative on cash to service our interest commitments that were there. But we've looked forward, and we believe that the next 2 quarters the operating numbers will be adequate to cover these costs.
Sure. And your capex plans, given the fact, one thing which I noticed was that your interest expense is about 40% of your top line. Correct me if I'm wrong. Going ahead, while things are definitely improving very, very strongly, but the risk, third wave and fourth wave remains. So are you going to still stick to your capex plans of 750 crores? I think that's what you said, 770 crores, out of which you spend something in the next 2 years, or if there's a possibility it could be spread out a little more depending on how the things pan out?
So Amit, our capex plan, major capex is for commercial building. Our cost of capital today is 7.5, and incremental returns, returns on incremental capex will be in high teens or maybe in the range of 20%. So we'll continue incurring this capex, complete these buildings. It will start earning revenue and EBITDA for us.
Sure. Thanks a lot. That's all from my side.
Thank you.
Thank you very much. That was the last question for today. I would now like to hand the conference over to Mr. Sanjay Sethi for closing comments. Over to you, sir.
Thank you so much. Thank you, everyone, for joining us for the call. Please stay well, and we are hoping along with you that there's no third wave. And even if it is there, we are pretty confident that we'll be, as a country, be able to handle it a lot better than the second one. We believe business is back, and we are very confident for the years ahead. Thank you.
Thank you.
Thank you very much. On behalf of Chalet Hotels Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.